The gold-silver ratio is crashing, not drifting, not fluctuating, crashing. And when this ratio breaks down like this, history shows it never happens quietly. Because this is not just about prices moving, it's about pressure building where the system least wants it. Silver isn't supposed to lead. Silver isn't supposed to outrun gold. And yet, here it is, doing exactly that. Which raises a far more dangerous question. What is forcing the market to reprice reality instead of paper? Behind the charts, behind the headlines, behind the reassurances, something is tightening, something is being demanded, and something. Welcome to Boring Currency Reports. If you've been watching quietly for a while, the way people do after they've seen a few cycles come and go, this might be one of those moments worth staying for. And before we continue, if experience has taught you that systems don't send warnings twice, subscribe now, calmly, deliberately, the way someone does when they know what matters. And tell us in the comments, from where are you watching today? They did not notice it at first. At a glance, it looked like just another week where gold was rising and silver was rising with it. Financial headlines framed it as familiar territory, safe haven demand, inflation concerns, routine market behavior. But beneath that surface movement, something far more unusual was taking place. A relationship that professionals had watched quietly for decades was beginning to fracture. That relationship was the gold-silver ratio. For most people, gold and silver are discussed as separate assets. One is viewed as a store of value, the other as an industrial metal with a speculative edge. But serious market participants do not look at them in isolation. They watch the ratio between them because that ratio reflects pressure inside the system rather than emotion on the surface. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio rises, it means gold is being favored over silver. When the ratio falls, it means silver is gaining strength faster than gold. Historically, that shift does not happen often, and when it does, it rarely happens without consequence. In calm periods, gold tends to move first. It attracts capital quietly, especially from institutions and central banks. Silver usually lags behind. It is volatile, smaller, and easier to push around. This is why silver leading gold is not treated as a normal event by professionals. It is treated as a warning. When the ratio begins to compress sharply, it signals that silver is being bid aggressively relative to gold. That does not reflect optimism. It reflects urgency. They had seen this pattern before. Not many times, but enough to know its character. In previous cycles, sharp declines in the gold-silver ratio appeared late, when confidence in pricing mechanisms began to weaken. They appeared when markets were no longer trading narratives, but reacting to constraints. That is what made the current move different. Gold was rising, but silver was accelerating. Not slowly, not gradually. It was moving with a speed that suggested something more than speculative enthusiasm. And silver does not behave that way at the beginning of cycles. It behaves that way when the market is forced to acknowledge limits. This is where many observers make a mistake. They focus on the price chart alone. They ask whether silver is overbought or whether gold has room to run. But experienced analysts ask a different question. They ask what conditions are necessary for silver to outperform gold in a market dominated by paper trading. The answer is uncomfortable. Silver is a smaller market. It is thinner. It is easier to stress. When pressure appears in silver first, it often means the system is absorbing demand it did not plan for. The ratio does not collapse because traders suddenly agree on a new story. It collapses when the structure beneath pricing begins to tighten. In normal conditions, futures markets handle demand through rolling contracts and cash settlement. Metal rarely needs to move. The system works smoothly because most participants are satisfied with exposure rather than ownership. That assumption has supported the paper architecture for decades. But when silver begins to rise faster than gold, it suggests that exposure is no longer enough for some participants. That is why the signal matters. The ratio is not reacting to fear in the news cycle. It is reacting to behavior. Behavior reflects decisions. Decisions reflect necessity. And necessity does not negotiate with narratives. They understood that silver's role in the modern economy makes it uniquely revealing. Unlike gold, silver is consumed. It disappears into power grids, electronics, medical equipment, and industrial systems. Once used, much of it is gone. That reality means silver shortages do not announce themselves loudly. They surface quietly through stress. When silver demand intensifies while gold demand remains steady, the ratio moves. When that movement accelerates, it suggests that pressure is building in places charts alone cannot show. This is why seasoned participants do not dismiss a collapsing gold-silver ratio as a curiosity. They treat it as a diagnostic tool. It reveals where the market is tightest and where confidence may be weakest. At this stage, the public still sees prices. Institutions see signals. They know that if the ratio continues to compress, it can force adjustments across portfolios, procurement strategies, and risk models. They also know that once the market begins to reprice reality instead of paper assumptions, the transition is rarely smooth. The early phase is often quiet, the middle phase is volatile, the final phase is chaotic. This is not about predicting the end, it is about recognizing the beginning. The gold-silver ratio does not collapse without reason, and when it does, it is not asking for attention, it is issuing a warning. The question is not whether the signal is real. The question is whether it will be understood before the system is forced to make it obvious. They had built the system on trust. For decades, the precious metals market functioned on a quiet assumption that almost no one questioned. Gold and silver would trade mainly as paper instruments, contracts would change hands, positions would roll forward, profits and losses would be settled in cash, and the metal itself would remain largely still, resting in vaults, rarely requested, rarely disturbed. That assumption was not written into the rules, but it was embedded into behavior. And behavior is what makes a system stable. In this structure, futures markets became the center of price discovery. They were efficient, liquid, and fast. Most participants were not miners or manufacturers. They were financial actors seeking exposure. As long as that remained true, the system worked. The paper market expanded, and the physical market stayed quiet. But systems built on habit are fragile when habits change. Over the past period, something subtle but important began to shift. Participants who once accepted cash settlements started asking for Standing for delivery is not a casual decision. It is more complex, more expensive, and slower than trading paper. It requires storage, logistics, and long-term planning. That alone filters out short-term speculators. What remains are participants who think in years, not weeks. This is why delivery demand matters more than price spikes. When large amounts of metal move through delivery channels, it suggests procurement. Procurement is not emotional, it is operational. It reflects a need to secure supply, not to chase momentum. And when procurement activity increases inside a system designed to discourage it, pressure builds quietly. The futures market was never meant to function as a warehouse. It was meant to facilitate hedging and price discovery. Physical delivery was the exception, not the norm. That is why rising delivery demand creates strain even when inventories appear sufficient on paper. This is where confusion often arises. Vault reports list large amounts of metal, but not all listed metal is available. Some is owned by parties who have no intention of selling, some is pledged, some supports multiple claims. The system functions smoothly only as long as those claims are not tested at the same time. That practice has a name. It is called rehypothecation. Rehypothecation is not inherently deceptive. It is a common feature in modern finance. The same asset can support multiple obligations as long as confidence holds. Problems emerge only when too many parties demand the underlying asset simultaneously. In calm conditions, that never happens. In stressed conditions, it becomes unavoidable. As delivery requests increase, the system must respond. It can encourage cash settlement. It can offer incentives to roll contracts forward. It can rely on the expectation that most participants will choose convenience over certainty. These tools have worked before, but they rely on psychology, not force. And psychology shifts when trust weakens. They understood that silver is especially sensitive to this dynamic. It is a smaller market with less readily available supply. It is more difficult to source quickly at scale. That makes it the first place where paper assumptions collide with physical limits. When delivery demand rises in silver, the system feels it immediately. Settlement delays are often the first visible symptom. They are explained as logistics, transportation, refining schedules, temporary bottlenecks. Individually, these explanations are reasonable. Collectively, they raise questions. Modern supply chains are optimized for speed. The bullion ecosystem is one of the oldest and most established in the world. When delays persist, it suggests prioritization decisions are being made behind the scenes. Who gets metal first matters. That is not a pricing issue. It is an availability issue. Availability is what the gold-silver ratio is beginning to reflect. Silver is being pulled faster because it is needed faster. The pressure does not originate from retail enthusiasm. It originates from participants who cannot afford to wait. The paper market can absorb opinions. It cannot absorb necessity indefinitely. This is why the ratio matters again. As silver is demanded physically, its paper price must adjust upward to ration supply. Gold, with its deeper liquidity and central bank backing, absorbs pressure more smoothly. Silver does not. The result is relative outperformance. They were watching behavior, not headlines, and behavior told a clearer story. When participants move from exposure to possession, it signals a loss of comfort with abstraction. It suggests that certainty is becoming more valuable than convenience. That shift changes everything. A system designed for trading becomes strained when it is asked to deliver. Prices may rise, but more importantly, confidence becomes conditional. Conditional confidence does not fail slowly. It fails suddenly. Part 2 is not about declaring collapse. It is about recognizing friction. Markets can tolerate friction for a long time until they cannot. And when physical demand begins to challenge paper architecture, the adjustment is rarely gentle. The gold-silver ratio is not reacting to fear. It is reacting to friction. And friction, once visible, does not disappear by reassurance alone. They had misunderstood silver for a long time. To many observers, silver appeared secondary. It was cheaper than gold, more volatile, and often dismissed as a speculative trade. In calm periods, it was treated as optional, nice to have, but not essential. That perception shaped how markets priced it and how institutions talked about it. But the real economy never shared that view. Silver is not only a financial asset, it is a working material. It sits inside power grids, solar panels, data centers, medical devices, electric vehicles, and advanced electronics. It carries electricity efficiently, resists corrosion, and performs tasks that alternatives cannot easily replace. In modern systems, silver is not decoration, it is function. This distinction matters. Gold can rise quietly because it is stored, not consumed. It can be accumulated without disrupting supply chains. Silver is different. Every ounce used in industry is an ounce removed from circulation. Much of it is not recycled because recovery is expensive or technically difficult. Over time, supply leaks away. That reality creates a different kind of scarcity. Mining does not solve this problem quickly. Silver production is not elastic. Most silver does not come from primary silver mines. It comes as a byproduct of mining other metals such as copper, lead, and zinc. That means silver supply responds slowly to price signals. Higher prices do not immediately create more silver. This is why silver shortages do not announce themselves loudly. They emerge quietly through delays, premiums, and procurement behavior. They understood that when industrial buyers begin securing supply early, it is not because prices look attractive. It is because availability matters more than cost. A manufacturer can survive higher prices. It cannot survive missing inputs. This changes how demand behaves. Investment demand can fade with sentiment. Industrial demand does not. When silver is required for production, it must be sourced regardless of market conditions. And when investors and industry compete for the same material, pressure compounds. This is where silver becomes dangerous for the paper system. The paper market assumes flexibility. It assumes supply can be called forth if price rises. That assumption works for assets that sit idle. Policymakers have begun to recognize this reality. Language has shifted. Silver is increasingly discussed alongside other critical materials. It appears in conversations about energy security, supply chain resilience, and strategic autonomy. These are not casual topics. When a material enters this category, it changes how governments and corporations behave. They begin to stockpile. They prioritize domestic supply. They reduce exports. They secure long-term contracts. These actions are not speculative. They are defensive. Once a material is treated as strategic, demand becomes less sensitive to price. Procurement decisions focus on certainty, not bargains. That is a structural change, not a cycle. What makes the current moment different is the overlap of pressures. Industrial demand is rising. Investment interest is returning. Policy language is changing. And the gold-silver ratio is compressing at the same time. These signals do not usually align. When they do, it suggests the market is adjusting to a new baseline, not a new price, but a new understanding of value. Silver is no longer being treated as excess. It is being treated as input. That shift undermines old assumptions. The paper market relies on the idea that supply can be mobilized when needed. Strategic materials are not mobilized casually. They are guarded. As silver is pulled into strategic frameworks, less of it remains freely available. That does not require panic buying. It only requires planning. Planning is quiet. This is why many miss the early phase. There are no dramatic headlines, no shortages announced on television. The signal appears in relative movements, in procurement behavior, and in subtle policy cues. The gold-silver ratio is one of those signals. It is not telling a story of enthusiasm. It is telling a story of dependency. Silver is being repriced because it is being recognized for what it actually is, a requirement. Part 3 is not about forecasting extreme outcomes. It is about understanding roles. When a market mislabels a dependency as optional, repricing becomes inevitable. Silver is correcting that misunderstanding. And when dependencies are repriced, the adjustment rarely stops at the chart. They understood that markets rarely speak directly. Instead, they communicate through signals, subtle shifts that appear long before headlines change or consensus forms. The gold-silver ratio is one of those signals. It does not shout. It compresses. And when it compresses quickly, it is telling decision makers that something fundamental is changing beneath the surface. At its core, the ratio reflects relative pressure. When silver begins to outperform gold, it means demand for silver is becoming more urgent than demand for monetary safety alone. That urgency does not appear without reason. It emerges when participants are forced to prioritize access over theory. For businesses, this matters immediately. Silver sits inside supply chains that power modern economies. When its price accelerates faster than gold, it signals tightening conditions that can ripple outward. Procurement costs rise, lead times stretch, inventory planning becomes more complex. Companies that rely on just-in-time delivery become exposed. For investors, the implication is different, but no less serious. The ratio's collapse challenges the assumption that paper exposure is sufficient. If relative pricing is driven by physical stress, then volatility is not noise, it is adjustment. In such environments, traditional models struggle because they assume liquidity where friction is growing. They recognize that confidence is the invisible asset holding the system together. The paper bullion market depends on confidence that settlement will occur smoothly, that metal will be available if needed, and that cash settlement is an acceptable substitute for delivery. As long as participants believe this, the system remains stable. But confidence is not binary. It erodes in stages. First comes preference. Some participants quietly choose possession over exposure. Then comes behavior. Delivery demand rises consistently. Then comes repricing. Relative value adjusts to ration supply. By the time confidence breaks openly, the adjustment has already occurred. This is why waiting for confirmation is risky. Markets reward early understanding, not late agreement. Decision makers who rely on consensus often discover that consensus forms only after opportunity has passed. They also understood the risk of bifurcation. When physical stress increases, markets can split. One price exists for paper contracts. Another exists for metal that can be delivered quickly. This divergence does not need to be extreme to be disruptive. Even small gaps undermine trust and price signals. For businesses, this creates budgeting uncertainty. For investors, it creates valuation ambiguity. For policymakers, it creates credibility challenges. Price becomes less informative when availability becomes the real constraint. The gold-silver ratio is hinting at this risk. Silver's relative strength suggests that availability, not sentiment, is driving behavior. That is a dangerous condition for systems built on abstraction. They were careful not to frame this as a prediction of collapse. Systems can operate under stress for long periods. But stress changes incentives. It shifts priorities. It exposes weak points. Silver exposes weak points faster than gold because it is both financial and functional. Gold can absorb distrust quietly. Silver transmits it into the real economy. This is why volatility increases when silver leads. It is not speculation alone. It is the system adjusting to a mismatch between assumptions and reality. For young entrepreneurs and business leaders, the lesson is strategic, not tactical. They must learn to read signals before they become problems. Ratios matter because they condense complex behavior into a single measure. When that measure moves sharply, it deserves attention. They must also understand that resilience matters more than precision. Perfect timing is less valuable than preparation. Companies that secure supply early, diversify inputs, and reduce dependency on fragile channels survive stress better than those chasing marginal cost savings. For investors, discipline matters more than conviction. Volatility punishes those who confuse narratives with structure. Holding assets one cannot tolerate through instability leads to forced decisions at the worst moments. The ratio does not tell anyone what to buy or sell. It tells them what to question. Why is silver being repriced faster? Why now? Why with such persistence? These questions lead to better decisions than forecasts. They also recognize the role of narrative management. When systems feel pressure, explanations multiply. Analysts appear to calm markets. Stories emphasize temporary factors. None of this is unusual. It is part of maintaining order. But explanations do not remove constraints. They only delay recognition. The gold-silver ratio collapsing is not a headline event. It is a structural message. It suggests that relative value is being reset because the old balance no longer reflects reality. For decision makers, ignoring such messages is costly. Markets do not offer many warnings before adjustment. When they do, those warnings are often dismissed because they are inconvenient. But history shows that the most important signals arrive quietly, before urgency becomes obvious. They knew that the question was no longer whether the ratio mattered. The question was whether leaders would act on what it implied. The ratio is not predicting chaos. It is revealing pressure. And pressure, once acknowledged, gives those paying attention one rare advantage: time. Those who use that time wisely rarely need to rush later.